Hello everyone, good evening. Welcome to episode 2 of Brazil-Ireland Chamber of Commerce Business Clinics. Today we are here again at the Zorda Media office. My name is Marco, I'm the founder of Zorda Media, and as you know, tonight I'm going to be your host. And thank you very much for joining us. So this is an online live, so that means that we will allow 5 minutes so people join. If you have any questions for now, you are free to drop them in the comments and then we will answer them to you. And in the meantime, if you can let us know, can you hear us clearly? Can you see me clearly? Is everything okay? Is everything going well there? If so, let me know in the chat and we will get going in about 5 minutes. And as people are joining, feel free to tell us in the chat where you're watching from and whether you're joining us for the first time. And just a quick reminder, everyone, the session today is being recorded and will be available offline as well. Well, not offline, but not live on BICC's channel here on YouTube as well. So even if after the event you'd like to revisit back in any of the topics, you have the chance to do so. And of course, as well, if you are enjoying the lives that we've been doing and if you like today's session, don't forget to subscribe to the channel and always be on top of everything that is happening here at BICC. Right, everyone, we'll be starting in 2 minutes. So I hope you got your water, your coffee, your tea. I don't know what you would be drinking at 7 p.m. I just had a coffee. It's going to be a long night, but it's going to be a fun one. Loads of interesting talks. Okay, amazing. So I guess we can start. Good evening, everyone, and once again, welcome to the BICC Business Clinics. The BICC Business Clinics is a practical webinar series organized by the Brazilian-Ireland Chamber of Commerce, designed to bring together experts from different sectors to share knowledge, practical guidance, and insights that support entrepreneurs, professionals, and business operating here in Ireland. Tonight's session is focused on financial compliance and business protection. Over the next hour, we hear from 2 experienced professionals, covering topics that are very highly relevant to business owners, founders, and entrepreneurs here in Ireland. We also encourage you to submit your questions through the chat, which we will be answering live, and we will collect as many questions as possible and address them during the Q&A session. So over the session, feel free to drop your questions. I'm watching them here on the computer. And as soon as we get to the Q&A session part of the talk, we will then ask them to our amazing experts. Before we begin, I would like to thank everyone else for joining us here this evening. And of course, extend a special thank you to our speakers for generously sharing their expertise with the community. So let's get started. Our first speaker this evening is Ian MacDonald from Core Accountants. Ian will be presenting Operating a Business in Ireland, Taxes, Charges, and Accounting Obligations. The session will provide a practical overview of the key tax, accounting, and compliance requirements that entrepreneurs and business owners should understand when operating a business here in Ireland. Ian, thank you very much for joining us, and the floor is yours.
Thanks, Marco. So great introduction. So my name. Hey everyone. So my name is Ian MacDonald from Core Accountants. I'm an ACCA qualified accountant with over 10 years experience. So hopefully a bit of advice and guidance will help you today. As Marco said, I'm talking about operating a business in Ireland, taxes, charges, and accounting obligations. So just more of the service that we provide with Core Accountants. So we help with company formations, business startup advice, company accounts, tax returns, whether that's company tax returns or personal tax returns, payroll services, bookkeeping services, and general business advice. We mainly specialize with kind of startup to small businesses, just helping people get off their feet. So tonight I'm going to kind of hit a little bit on the topic that was on the last clinic with the business structure, but more on the accounting side. So two of the main structures I'll be talking about is whether to set up as a sole trader or whether to go as a limited company. So what's really specific in here is each case that will come to me, it's always going to be bespoke advice will be given out. So everyone is going to be different advice for different people. So the main factors we'd be considering is, do you have a business plan? So what is the plan for your actual business? It's like when you're studying for an exam, the more you've planned and the more you've studied, the better it's going to be. So is the business, is it seen as a long-term business or is it short-term? If you're working full-time and it's a little bit of a side hustle, it could be better to set up as a sole trader. Dip your toes in the water rather than setting up straight away as a limited company and incurring a lot of cost starting up. Another factor to consider is, do you have any partners or shareholders in the company? Setting up as a limited company can be an easier way of splitting out the shares between each person, rather than as a sole trader. You'd be registering for income tax and actually setting up a partnership, which you'd need proper legal documentation for. So first thing is sole trader. So what is it? So basically with a sole trader, you are actually the business. So it's very simple to start as a sole trader. So you're just setting up either trading under your own name, or else you're registering a business name with the company's registrations office, which is the CRO. So with a sole trader, filings are very simplified. So you're just registering for income tax and filing a Form 11 income tax return each year. So with the limited company, what exactly is it? So with the difference between a limited company and a sole trader is, the sole trader, you are the business. With the limited company, you're two separate entities. So it's you and also the limited company. So again, the company will be set up through the CRO. A way of extracting money through the company will be through the payroll. So as a sole trader, the business goes through you. The limited company, you're going to be paying yourself through a payroll. So just on your screen here, I have basically the differences between the sole trader and limited company. So the limited status, so you are the business as the sole trader. Again, limited company, two separate entities. One of the main advantages of being a limited company is you have limited liability. So if there is a case that goes against you or the company, your personal assets actually aren't at risk. So that means the limited liability. With the sole trader, it's more unlimited. So your personal assets can be actually at risk. The tax rates, we'll go through this little bit later as well. But for a sole trader, you're going to be paying income tax on your profits. So 20% PAYE tax up to 44,000 in profits. Anything above that, you're saying 40%, the higher tax rate. Any profits in the limited company, you're looking at 12.5%, which everyone likes the lower tax rate. The setup costs and everything, so with the sole trader and the limited company, the sole trader, it's a lot more straightforward to set up. So all you're doing is registering for income tax, and if you're trading under a different name, so if I set up a burger stand and I'm trading under Ian's Burgers, I'll be registering Ian's Burgers with the CRO as a business name. So it'll be Ian MacDonald trading as Ian's Burgers. With the limited company, the setup costs are a little bit higher. So you're again going to the CRO, the company's registrations office, and you're filing an A1 form. You're going through all the process. It takes a little bit longer. The process is a little bit more expensive than setting up as a sole trader. And you're also going to do procedures like registering the beneficial owners on the register of beneficial ownership. You're going to also purchase a company seal for the company, which is required along with the guidelines. So that's basically any legal documentation, you're putting your company stamp on it. So a little bit like Game of Thrones with wax, with the family sigil on it. And then also registering for the various taxes. So corporation tax is one, and more than likely to extract the money from the company, you'll be processing that through a payroll. So the payroll tax will be something else. The filings between the sole trader and limited company, fairly straightforward with the sole trader. You're just registering for income tax and filing a Form 11 income tax return every year. With the limited company, you're filing your CT1, your corporation tax return, and then you also have to file your B1 annual return along with a set of financial statements every year. As if you're more of a startup business, you may be seen as a proprietary director, which owns over 50% of a shareholding in the company. So you're going to actually have to file a Form 11 income tax return as well, along with your company filings. Profit retention. So with the sole trader business, basically on all your profits, you're going to be paying income tax and at the appropriate rates. So you don't really get the option of kind of retaining the profits. You're paying tax on all those profits. With the limited company, you're paying the tax at 12.5%, but with the retained earnings or retained profits that you have in the company, you have the options whether you want to pay yourself a bonus and pay your income tax on it, or maybe you want to actually pay into a pension contribution and make it directly from the company into your own personal pension. And I'm sure Michael as well from Senna Brokers, he'll be talking about that much later as well. So just moving down. So I have an example, a few examples here just to show whether you should go as a limited company or stay as a sole trader. So we have Sarah, who's a full-time employee for Google. She earns over 100,000. So that 100,000, she'll be getting her pay slips, and her tax will be deducted every time she receives her pay slip and paid on behalf of her by her employer. So she also has a side business which makes about 5,000 extra of income. So if she decided to go as a sole trader, you'll see on the left-hand side, she'll pay a total income tax of 2,600. And if she goes to register as a limited company, she'd actually pay €625 in tax. So on the face of it, you would actually say, let's go with the limited company. But the actual conclusion here would be, with all the professional fees, we're actually extracting money from the company to Sarah's actually own account. She'll have to actually pay that income tax anyway. So the advice here would actually be, Sarah, stay as sole trader, because it wouldn't be actually worth setting up as a limited company. And also the main reason is she has this as a side business. She might actually stop the business later on, maybe if she thinks it's getting in the way of her employment. So it's better just to say, okay, I'm dipping my toes in the water, pay that income tax as a sole trader. So as I said here, conclusion, with the additional professional fees, so like doing the annual return, the financial statements and everything with the company, the costs and everything, Sarah will be able to take away very little if she even chose to set up as a limited company. Moving on to another example with Carol. So Carol doesn't have any employment income. She works full-time in her own business, and she has profits from the business of 100,000. So for the example on the left is the sole trader. She'll pay with all the income tax. Out of that 100,000, she'll take home just over 64,000 and pay taxes of just over 35,000. So it's fairly significant, the amount. The higher she earns with the income tax, the higher the amount of tax that comes out. Option one with the limited company, it's a little bit more unrealistic, because with Carol actually just working for herself, she's going to want to be able to extract money from her own company. But just given the example, the 100,000 at 12.5% with no salary from Carol, she pays a total tax of 12.5%. So a significant amount less than the sole trader. The option two is when she goes with the salary of 60,000 from the company, from the profits. So that 60,000 is actually an expense to the company. From that, she will pay 15,000 income tax from it over to revenue, and her take-home pay from the 60,000 is just over 44,000. So then on the remaining 40,000 in the company, the profits, she'll actually pay 12.5% on that, which is about 5,000. Again, reverting back with Michael with Senna Brokers for later on, that 40,000, she can actually choose to pay a contribution into a pension, which will actually reduce her profits down to zero. And then she'll take home a salary of 60,000. She'll put 40,000 of a pension contribution into her own name. So she'll actually get the benefit of about 100,000, and then she'll pay a total tax amount of 15,000 on that. So clearly here, option two with the limited company is much more beneficial than the sole trader, where you're paying 15,000 extra in tax. So moving on to the business taxes every business owner should know about. So going back to the corporation tax, which is taxed at 12.5% on trading profits. There are other tax percentages, 25% on non-trading profits, so the likes of investment income, such as rental income, that's more at 25%. With income tax, the income tax is basically sole traders, it's the tax on the profits of the sole trader business, and it's done through PAYE, USC and PRSI. So PAYE is pay as you earn, USC is a universal social charge tax, and PRSI is pay-related social insurance. So we'll touch back again on those just in the next slide or two. Another tax everyone should know about is the VAT. So you've the standard rate of VAT at 23%. So that's on such things such as accountancy services. So for example, if I charge somebody €100 plus VAT, I would actually be receiving €123, but my sales amount would be 23. It costs the person €123, and if they're not VAT registered, they can't reclaim any of the tax. So we'll talk about VAT a little bit later as well, about how to reclaim the VAT on the purchases. The reduced rate, something just about the reduced rate, so the hospitality sector. So I think it is the 1st of July, there's going to be a reduced rate from the 13.5% down to the 9% for the hospitality, so restaurants and cafes. So that's just something to consider if you're in that industry. So the construction industry as well, so if you're getting the likes of a plumber, electrician or carpenter, if they're actually giving you an invoice, it's more than likely for supply and install, and your invoice will be at 13.5%. The second reduced rate is at 9%. We talked about the hospitality that's going to be in effect at 9% from the 1st of July. But actually, your electricity bills and your gas bills, when you look at that, the VAT is actually charged at 9% on that, so a lower rate. Any businesses kind of wondering what is VAT exempt? So VAT exempt is on like car insurance. If you're actually setting up a business and you're renting a property, the Dublin City rates will actually be VAT exempt as well. So that's just something to consider as well. So it's not just You won't be just paying your rent, you'll be paying your rates as well. So then touching again on the payroll taxes, more on the employer side. So again, you'll have your PAYE, your USC, your PRSI, but the extra charge for the payroll taxes for the employer is employer PRSI. So that's where it costs a little bit extra to run a payroll through a company. Something very important now that a lot of people don't take into consideration is extracting the money from the limited company. So the main way to extract the money would be through a payroll, so paying yourself through your own payroll, or if you have company profits, you're going to be paying your money through your dividends as well. The next points are more that are underutilized, but they're amazing ways of extracting money and being as tax efficient as possible. So the first three will actually get disclosed in your payroll. So you'll be claiming mileage from using your personal car. So say, for example, I drive from Dublin down to my office in Dublin, drive to Dublin, down to Cork, and drive back. I can actually claim mileage on that trip using my personal car through the company. So I think it's around 50 cents. There's different bands and everything for claiming the mileage, but it's around 50 cents per kilometre you can claim on that. Same with the daily subsistence rates. So subsistence, you can actually claim about €19 for being away from your place for work for about 5 hours. The main one here is the small benefit exemption. So this is basically tax-free money that you can pay through a prepaid card, so like a prepaid MasterCard, or actually like a one-for-all card. So you can get this through the company and paid over to you, and there's no taxes on it, and it's actually a tax deductible expense for the company. So just to give an example on that, if you wanted to give yourself a bonus through the payroll in the company of 1,500, about 52% of that will be actually taxed. So instead of paying about over €750 in tax over the revenue, you can actually run the small benefit exemption, and it can be up to 1,500 for the year. Other ways of taking out money, so if you have profits in your company and your cash flows are looking fairly good, I'd always recommend, and again, Michael from Senna Brokers will be touching on this, I'd always say make contributions into a pension scheme. So whether it's a PRSA or kind of other schemes as well. So it's a great way of, we've seen in the previous example, of extracting money, moving money from the company basically into your own personal name. The only problem with the pensions is you don't get the benefit straight away. It gets put into a fund, investment fund and everything that you can use when you retire. Another point I'll actually slightly touch on is adding a family member as well to the company payroll. So if you've somebody, a husband or a wife that's maybe looking after the kids, that is a little bit involved with the company, you can actually add them to the payroll and utilize their tax credits as well. So maybe you're a high earner and being taxed at the 52% of the income tax, you can just utilize your partner's tax credits there. So going back to VAT, so when to register for VAT. So you actually have the option to register for VAT at the beginning of the business, or when your annual turnover exceeds, for sales of goods or sales of services, 85,000 for goods or 42,500 for services. So that's when your sales, when you're doing your bookkeeping and keeping records of that, when your sales gets above, for goods, 85,000 revenue guidelines, you have to actually register for VAT. The other option, so voluntarily or electing to register for VAT. So when is this actually a good idea? So this is more around startups with significant VATable costs. So for example, if you're setting up a restaurant and you're purchasing a lot of equipment and the fixtures, fittings, everything, all these costs include VAT, you can actually elect to register for VAT at the very beginning and reclaim all this VAT back. Because if you're not doing this, then it just means that the extra VAT that you're paying, you're not reclaiming it, and it's more costly for you. The other example is the B2B service providers. So your clients, so business to business, normally when other businesses are VAT registered, they can reclaim the VAT on your purchases. So for the example I gave with the accountancy fee, the €100 plus VAT, if I gave that to somebody that's not VAT registered, they can't reclaim the VAT. If you are VAT registered, you can reclaim the VAT back on those fees. So it's no extra cost to those B2B customers. Credibility as well. Some larger businesses actually prefer dealing with VAT registered suppliers. So again, electing to register for VAT, the pros and the cons. So again, just going back over the other points, reclaiming VAT on your business expenses, the extra credibility between business to business clients, and also the credibility actually shows, once you're registered for VAT, it shows you're a well-established business as well. The cons, you actually have to file a VAT return, so it's going to take up a little bit of time. You're going to have to actually calculate your VAT on your sales, your VAT on purchases. You're going to have to keep your bookkeeping up to date to be able to produce the VAT returns. So a lot of people just don't like the extra admin that comes with that. Cash flows as well. So for example, if you have 20,000 in the company bank account and your VAT return is due at the end of the month, when you click in on, if you have your books and records up to date in your bookkeeping system, you'll log in, you'll find you have a VAT liability of 15,000, and then you can actually plan then saying, okay, that 20,000, I can't just go and spend this on stock or extra equipment, because we're going to have a liability at the end of the month or the second month. So that 15,000, you don't pay for the extra stock and spend that money, and then all of a sudden the VAT liability pops up. So it's important, the cash flows as well. Business to B2C customers. So again, if your clients aren't actually VAT registered, it just means the VAT added on top of your sales on your invoice. It just makes your service or your goods that little bit more expensive. So moving in, just talking about the payroll, just one of the obligations as an employer setting up. So for employers to pay employees, it must be done through a payroll system. The income taxes such as PAYE, PRSI, they get deducted from the employee gross pay and paid to revenue by the employer on behalf of the employee. Whether you're doing the payroll through your own business or whether you have an accountant doing the payroll, they'll have their own payroll system which will actually import the tax credits of the employee. So when those tax credits get imported, if the employee doesn't have something like a PPS number, or they have a second employment and all their tax credits are with the other employer, then the employee might actually be emergency tax. So it's the dreaded thing for employees. Employers, it doesn't make a difference, because it just means you're paying more tax over to revenue and the employee receives less of a net pay, and then vice versa, switching the other way. Something to really look out when setting up your payroll and when you have employees is the Workplace Relations Commission, so the WRC. So they're a body promoting good workplace relations. So basically these come in, they can have unannounced visits into your workplace. Generally speaking, it's more the hospitality sector or the health and beauty sector, where they'll be going in and they're just basically asking, are your employees, are they paid above the minimum wage, paid the minimum wage or above? Do you have contracts of employment in place? Are the employees getting their holidays, their bank holiday pay? Are they, if they work on a Sunday, are they getting a Sunday premium? So all the rights and everything for the employees. They also will check their record keeping, so making sure that everyone's legally able to work in Ireland. So are their visas, have they expired or not? Also in the hospitality sector as well, with regards to tips. So customers will not generally leave a tip and everything for good service. So looking after the tips, they need to have a good control in place just to make sure that the employee is being paid their tips and what they're owed. So just touching on what is an employee, what is a contractor. So an employee, your employer controls how, when and where you work. Your contract will say you must work yourself and you can't pass it on to somebody else. Your contract sets out specific work hours and amounts. You're paid a fixed wage and you're paid through a PAYE system. So you'll receive your pay slip at the end of the week or at the end of the month. And moving on to the contractor. So the contractor will more so own their own business. They'll bear the financial risk of their business and their work. They can decide to work themselves or they can hire somebody else to come in. They can choose when and how to work, and they can refuse work offers, and they can work for multiple clients, and they're paid through the self-assessment. So doing a Form 11 income tax return and filing that every year. If there is ever a visit from Revenue or from the WRC, the Workplace Relations Commission, there can be issues where some employers would rather pay as a contractor rather than as an employee. So the framework that the WRC and Revenue will use is the employment status framework. So going down through the 5 points here, work and wage bargain. Is there an agreement covering the exchange of work for pay? Personal service. Is there an agreement to provide personal services with limited substitution? Control. Does the business control the worker? So the hours that they work, the place that they work. And then what are the facts? What is basically the facts, the factual matrix? So do the circumstances point towards an employment contract? Legislative context, so the laws, is there any law indicating that it's not a contract of service? So if you go down through all of those points and they're all yes, then you have an employee rather than a contractor. Consequences would be, as a contractor, you would get away with not paying the employer's PRSI, but as an employee, it just gives the employer a little bit more of a cost with that employer's PRSI. The social welfare benefits and the employee rights and entitlements, they come together. So again, the WRC will just be making sure that the employee has statutory sick pay, they have holidays, they accumulate the holidays and bank holiday pay as well. So being a contractor, you don't have any of these rights. So as an employee, you actually have more rights. So bookkeeping, why it matters. So the consequences. So consequences of poor bookkeeping would be missed expenses. So if it kind of leads into the second point as well. If you're missing out on your invoices, you're not putting it into your bookkeeping system, your profits are going to be higher because you're understating your expenses. So then you'll end up overpaying on your corporation tax because your taxes will be higher. And then also with your VAT, if that invoice that you didn't put into your system had VAT on it, you haven't reclaimed the VAT on that. Same as well, cash flow issues as well. So you need to know, is your business viable? Is the money coming in greater than the money going out? So with a good bookkeeping system and good processes in place, you'll know, is your business actually viable, and it'll keep an eye on your cash flows. Revenue audits, so if you ever got a revenue audit in relation to, say, your VAT, you actually can go back to your system now, and a lot of the systems now, you can actually import in your invoices, your PDFs, keep your books and records there, so they can help out with revenue audits when revenue comes asking for questions. 5 of the biggest mistakes that I see, this actually could be a lot more. I'll fly through these now, but poor planning. I'm a big advocate for planning. As Reich Ian always said, is like fail to prepare, prepare to fail. So when we gave the example of the restaurant and reclaiming the VAT at the beginning, if they didn't actually get consultation and they went ahead, paid for all the renovations and fixtures and fittings, didn't reclaim the VAT or register for VAT, then they've overpaid and it's become more costly, the mistakes, rather than getting a bit of advice, making a plan and getting the proper advice to register for VAT, so it can be more costly to them. Mixing personal and business expenses. So when setting up either as a sole trader or as a limited company, I'd always say have a separate personal bank account and your business bank account, just to keep the business expenses and personal expenses separate. Incorrectly extracting money from your limited company. So the main way to extract the money will be through a payroll. if there's money going from the limited company bank account into your personal account, there can be a company law issue. The example I always give with this is if you go to the bank with the limited company, you get a loan of €1,000,000, it goes into the limited company bank account, and then you say, okay, I'm putting that in my personal account, and then you go to the company and say, I'm closing the business account, and then the bank is looking for their money back. Well, they're not going to get it. They're not going to get it. You're saying, oh, I'm declaring bankruptcy. You've paid yourself a loan from the company to yourself, so it's actually a company law issue, so you could end up in court and in a lot of trouble. Not maintaining your accounting records, so that speaks for itself. So that can lead to revenue intervention, and if you don't have your books and records together, it can lead to extra charges and penalties. Missing filing deadlines, so your accountant will normally be on top of you just with your tax returns, your filing deadlines for those, your company accounts, your filing deadlines for them. But if you ignore all your advice from your accountants and you still miss those deadlines, you're going to get extra late filing fees, surcharges, interest. And then with the company, if you miss your annual return deadline, then you could lose audit exemption, which leads to extra fees. So final advice, planning. Get professional advice early, maintain your good records from day one, understand your cash flow, so the money in, the money out, then separate your business and personal finances. And one of the main things I encourage, don't be afraid to ask questions, whether you think they're silly or not. Every day is a school day, so we're here to pass on our knowledge to you. So if you don't know something, you might think it might be silly, but you're gaining knowledge from that. So don't be afraid to ask any silly questions. So if you want to get in touch with us, or if there are any questions, I have my details on the screen there now. You'd be, going back to the examples I have in the slides, it can relate to how are you setting up the business. So is it a long-term business? Because if it's really going to be a long-term business, I think straight away setting up a limited company can be your best option, especially if it's going to be just yourself as a shareholder. You have total control over the business, and it is going to be long-term. So you're going to see the company growing, and instead of setting up as a sole trader and then gradually moving to a limited company, you can also do that straight away from the beginning. A big example or a big thing I'd always push is, what are you planning with? If you're going for a mortgage, it can look a lot more professional setting up as a limited company rather than submitting sole trader accounts. It does look that little bit more professional. Also, depending on your profits, as you've seen in the previous examples, depending on your profits within the business, the sole trader business, it's a lot more tax efficient at certain times to move over to the limited company. So yeah, that'd be it.
Okay guys, maybe now you can hear me. Let's just wait for a quick second so we can see.
Yeah, can hear but like from there.
Okay, I guess we're back. We're back, everyone. Let's go. So we have a new question here for you, Ian. So the second question that we have is, many entrepreneurs focus on the 12.5 corporation tax rate. What other tax considerations should they be aware of before deciding to incorporate growing business?
Yeah, the VAT as well. So again, mostly with startups, they incur like significant costs. So reclaiming that VAT early rather than leaving money, basically throwing money away, it can be a significant thing to think about. It's like it always comes back to how you want to start up the company. So when you're incurring those significant costs at the beginning, it's definitely going to be VAT. It'd be the main one I'd consider.
Okay, amazing. Thank you very much, Ian. So next question. We actually have loads here for you.
Oh God.
So what are the most common mistakes you see entrepreneurs make when choosing between a sole trader and a limited company?
Yeah, it's probably even how are they ready. So if say they have a business and it's more as a sole trader or a partnership, they mightn't actually be ready to move in. Like they might be actually working full time, and their kind of self-employed business is like their side gig. So they might be moving a little bit too early because they're going to be investing their probably savings, they're probably going to be taking out a loan to try and push moving into their sole trader business. And then also at the same time, it just gradually leads into your limited company. So just trying to hit the sweet spot of kind of transitioning from maybe a full-time employment to then moving into your sole trader or your self-employed business. It's all about your timing, that you don't do it too early and then all of a sudden you're putting yourself financially under pressure, that you don't have that guaranteed income from your pay slip. You're fending for yourself basically. So yeah, it's kind of trying to find the transition from the very, very, very beginning, from your employment when you're working for somebody else to going full-time by yourself.
Okay, amazing. Thank you, Ian. We actually have one more question here. Not only one more, we have actually a few. So many entrepreneurs, no, I asked you that already. What is the main difference between a partnership and a limited company? And in your opinion, in which situations is each one more advantageous?
So the partnership can be more you're registering the business name, and it's like you're a sole trader, but you're in partners with somebody else. So in your Form 11 income tax return, you and your partner will have to do your tax returns and submit the profits. It just gets split. If it's two people in the partnership, your profits just get split maybe 50-50. So yeah, that's basically your partnership. Then the limited company, what is it, transitioning into the limited company? Is that the question? So if you're then moving into your limited company, you're more so getting a shareholding in the company, and then you're more an employee of the company rather than the risk. The partnership and the sole trader business, they're very, very similar, apart from you're sharing the risk and the liability that you would be with the partnership. The limited company, it's just a limited liability.
Yeah, brilliant. I think that answers part of the questions that we have. But then I think the question here is more like, what are the difference between, I think which we covered that, but is in your opinion, in which situations is more advantageous to have one or the other, like a partnership or go and set up a limited company?
Yeah, I think with the partnership, especially, again, if you're thinking long term or short term, if you're dipping your toes in to see, is this business going to actually, is it going to work? It's better setting up as a partnership, because you don't want to spend all this money to set up a limited company, and then all of a sudden after a year you're saying, okay, didn't work out, or the partnership didn't work out, and you're closing down. So then you're going to have the costs of doing your annual return, your financial statements, and then you're going to have probably a voluntary strike off to close the company. So more so at the beginning of the process, the beginning of the whole partnership, it is better to have a partnership and be registered for income tax rather than registering a limited company.
Okay, amazing. Thank you very much, Ian. Next question. What happens if a business exceeds the VAT threshold and doesn't realize it straight away?
Yeah, so this is where I always advocate for good bookkeeping. So keeping up to date with your bookkeeping and your records. If revenue can kind of give unannounced visits, because, for example, if you have a hairdresser's and you're renting out all the chairs, there could be an unannounced visit from revenue where they say there's 5 chairs, €500, €500 a week, that's what they're paying. So I've seen they've started from this date and they're now at this date, and between those 2 dates they are going to be above the sales threshold. So revenue can actually come after you, and they'll say, okay, we know the amount of money that you've made from these periods, we're going to expect this amount of VAT, and you should have actually registered already and start paying VAT to us. So it's on you to have a good bookkeeping system in place, know the amount of money, the amount of sales, because as your business grows, you're going to expect to go above the threshold, whether it's services of 42,500 or even sale of goods. So if you, again, a restaurant, you're probably going to be exceeding that before the 12 months. So you're expecting to do that. So you're expected to also keep up to date with your bookkeeping and knowing how much sales you've made.
Okay, amazing. Thank you very much. We have a question here from Juliana. And the question is, many small businesses engage contractors rather than employees. What risks should they be aware of when making a decision?
Yeah, again, if you're going to the hospitality sector, if you get an inspection from the WRC, which can be unannounced, or even revenue, they can come in and without a business owner or manager being there, they can be asking questions to your staff. So they'll be asking, are you getting show us your pay slips? Do you have a contract? How much are you being paid? So if you're just paying them as a contractor, first thing they'll look into, well, are you dictating the hours that this employee or this person works? Are you telling this person where they're working? Then they might say, well, this is actually more so classified as an employee rather than a contractor. If it's more so seen you're paying them as a contractor and they are seen more as an employee, it can lead to you're ending up in court. With revenue, you're not paying the employer's PRSI, you're expecting the contractor to actually file their own tax return, so there's no payroll taxes as well being paid monthly or weekly. So there can be kind of significant enough consequences. So that's why it is tempting to hire somebody more as a contractor and say, give me an invoice. But the correct way to do it is ask the questions, go through the framework, see are they an actual employee, do you dictate when they work and how many hours, And then if they are an employee, you just have to, unfortunately, bite the bullet, add them to a payroll and pay them all their entitlements as well. Because that's another thing, the WRC, if they're seeing, these are seen more as contractors to the employer, then the employer isn't recognising their statutory sick pay, any holiday pay. Even if there's termination payments, there's nothing in a contract to protect the person that's working there. So in fairness with the WRC, they're looking out for the rights of the employee, whereas the employer, it is more beneficial cost-wise, but it can have a larger impact and a larger cost if they are seen to be breaching paying as a contractor rather than as an employee.
Okay, amazing. Thank you, Ian. We have here now a question from Pedro. For members of the Brazilian business community who are either starting or expanding a business in Ireland, what would be your key recommendation?
Planning. I had someone get in touch with me last year where they wanted to spend all their savings, and their idea was setting up a burger van in the middle of O'Connell Street. And I thought, great, you're really ambitious, great idea, but have you actually thought this through? Do you actually know, are you allowed to set up basically beside the spire? And I was like, I don't think you do. And he said, I never even thought of that. Do I have to ask for permission? So planning, knowing exactly whatever sector or whatever business you're getting into, you have to research. There's market research you have to do. There's certain things you need to reach out for professional advice. The likes of if you're renting a premises, do you know when you're paying rent, you're going to also be paying the light and heat, the gas, the electricity. You're also going to be probably paying, if it's a commercial building, probably rates as well. So there's a lot of hidden costs as well with setting up a business. So the more you're prepared to set up the business, the better, the easier it is, the less shocks that you'll get to your system.
Amazing, thank you very much. We have one more question here, actually two, but I'm gonna compress them into one, and then we're gonna close the questions for Ian to make sure we are still moving in a right amazing time, because we still have another amazing expert here talking to us tonight. So, next question, right? Can a sole trader still hire people, and how limited is a sole trader in terms of scope of work?
So yeah, if you're trading as a sole trader, you can set up a payroll. You're basically, it's a business, whether it's sole trader or limited. It's just more the tax implications on, say, your profits and stuff and your liability. So yeah, no problem. You can register for VAT, you can register for your payroll taxes and do a payroll with either a limited company or sole trader. Sorry, what was the second part of that?
So the second part of the question was, how limited is a sole trader in terms of scope of work?
Scope of work, I think it's more the way, so for example, if you're going for a mortgage, I think it's seen more as a professional body when you set up as a limited company. So being a sole trader, when you get to a certain point with profits and everything, it's seen as less tax efficient than when you have a limited company. You have more options as well with the limited company as well, because again, going back on one of the examples in the slideshow, if you have significant profits with your sole trader business, you're paying a lot of tax. Anything above 44,000 in profits, anything above that is taxed at nearly 52%. With the limited company, it's 12.5%. You can choose what salary you pay yourself, and then any profits left over, you can say, okay, that's at 12.5%. Or else you can also say, I want to set up something like a company pension, as Michael is going to go through later on. So you can you just have a lot more options then with the limited company there.
Okay, amazing. Thank you very much, Ian. That was an amazing session. That was very, very, very helpful. And thank you very much for answering the questions of our beautiful and amazing community. Right now, everyone, we are gonna go on a little 3-minute break just so we swap our amazing experts here in the studio, and we will be back with you very soon. So go get some water, refill that tea or the coffee, although it's 8 p.m. I don't know if you should be drinking coffee, if you're planning on that, and we'll be back soon. Okay, so we are back. I actually would love to know in the comments if you did get water, coffee or tea. I'm curious to see if anyone is drinking coffee at this time of the night. Now, we are back here with our second speaker, and it took me a long time to learn how to speak his surname. We are here now with Michael Kashmirchik from Sena Brokers Limited, and Michael will be presenting Securing Family and Business Futures, Financial Planning for Founders. In this session, Michael will introduce financial planning and protection strategies designed to help founders, entrepreneurs, and families prepare for the future with greater confidence. Michael, thank you for being with us here this evening, and over to you.
Hi Marco, thank you for having me here. I'm Michael, Director of Sena Brokers Limited, and I will be talking today not about really products, but financial tools to help you with financial planning. And just a little bit about myself. I have over 20 years experience in financial services industry. Just trying to figure out here the slides. Our company is regulated by the Central Bank of Ireland. We have 3 authorizations from the Central Bank where we can deal with specialized investments, mortgages, and life assurance products. We do provide advice in 3 languages, English, Polish and Portuguese. And we provide impartial advice. Impartial advice, for those who don't know, it's a different word for independent advice. We have a pleasure to support families, individuals and business owners with arranging various products like mortgages, pensions, life assurance, income protections and retirement planning and general financial advice and general financial planning. Just here, financial planning really comes back to one of those 4 questions. What happens if I die? What happens if I get seriously ill or I cannot work? And will I have enough money in the future to retire? So from today up to retirement, that span of time, we will be talking about the risk, financial goals, family and business. And so the risk, what is the financial risk between today and before retirement? So if we take an average Joe aged 30 and he has 35 years to retirement, you know, most people will say that the biggest risk for him is to die. Actually, that's the smallest risk. You know, the biggest risk for Joe is not being able to work within that period of 35 years. And hence, you know, that is actually the smallest risk. Serious illness is somewhere in between, but unable to work is the highest risk for Joe not being able to work for over a month. So 55%, over half of the risk during that period of time is that at least one of those events will occur. Then I will bring up the financial pyramid of financial planning that I put together for purpose of this presentation. So if we look at the pyramid, we have the importance and the foundations of everything actually in financial life is your income, ability to actually generate income. And the same for the business side is ability to generate profits. So income is the foundation of every decision we take towards a certain goal. And the next part, it would be represented by protection, where you should protect your income, family and your business. So on the side of how do I protect myself as an individual or as a family member, there are tools or products to protect your income as a income protection or permanent health insurance. On the business side, the products would include key person insurance or executive income protection. Now, the next and the very important part of the pyramid is family goals. So that would include your home, your children, and overall well-being of your family. So those 3 bottom layers of the pyramid, I would call the pillars of your protection. This is what you protect. This is what constructs your financial life. It's your family, it's your business, ability to work. And protecting everything plays crucial role in your financial well-being life. Now, the next, everything else is pretty much built on top of those 3 pillars. And retirement planning would be something that Ian mentioned is important when you're running your business, and how do you extract and lower your corporation tax, and how do you extract legally money from the company without paying income tax. And that's where the retirement comes into retirement planning comes into play. And this is the same for the individual. On the individual side, it would be, how do I build my wealth, but do not work harder, however, pay less income tax. And that would be the retirement planning around. Now, investments are always seen as a tool to create that wealth. So overall goal is building and creating wealth for the future. And simply through retirement planning, taking investment as a tool, that's how you do create your wealth. And once this is achieved to a certain point, you might be thinking as a business owner, how do I now implement future business strategy to exit? How do I retire without paying huge amount of tax? And that's when financial advice comes into play, and it's just paramount into at that point of your well-being. And Ian from Core Accounts would be helping you to set up that kind of plan, along with Sena Brokers, for example, to create that business strategy onto how to pay less tax and how to extract the most amount of money beneficial for you and your future. And that's pretty much for business owners, but mostly for individuals and family people and any other employees would be, how do I grow and preserve that wealth? And so what is your biggest asset? Most people would say, it's my house, it's my health, and so on. But the biggest asset is your potential future earnings, your ability to actually work and generate income. And it's the same for the business. But here I brought up a simple, quick example of an average person of age of 35 earning 60,000 euro per year and having 30 years to the retirement. So potential future earnings are 1.8 million. It's a huge amount. And, the taking from that slide, I would ask, why people do insure their phones, mobile phones, but they do not insure their income? You might ask yourself that. Have you bought insurance on that new TV you just hang on the wall? So income protection, salary generates the income, and with that you can pay your mortgage, your food, your bills, your lifestyle, and pay the business expenses. Now, if you are not able to work, none of that can happen. So no mortgage gets paid, bills get unpaid, and your business can stall and not being able to generate. And especially with the small companies and businesses, or self-employed, as Ian was talking about, the difference between sole trader and limited company. And this is huge. You are a sole trader, you are the business. If you are not able to work and generate that income, that's pretty much it. There's no income coming to the household. So what income does, it replaces your monthly income, and all the way up to retirement age, you can get 20 or 40% tax relief on premiums. So pretty much 40% taxpayer, 100 euro premium per month would cost him only 60 euro. And it covers illnesses and injuries. And so the definition and a little bit more details about the income protection, because it's quite important subject. It covers up to 75% of your salary, less the state illness benefit, okay? You have the tax relief, and it can be linked to your particular occupation. Now, for business side, you can avail of executive income protection, where a company gets, basically, it's an expense, so they pay less corporate tax at the end. Now, the two types of important protections would be serious illness and income protection. Income protection we just discussed, and usually the most common claims would be around your mental health, back or joint injury. I have a friend who slipped his disc and was not able to work for 2 years. 2 full years, no income. He was only relying on his spouse income. Now that's something that you could consider, okay? With income protection, the important part is deferred period. So as an employee, you would be paid by the company, let's say for first 6 months while you are not able to work. Therefore, deferred period means that when does the claim or the income protection actually starts. So it would be the first 6 months you can avail of, first 26 weeks as a deferred period, so the income protection doesn't kick in till 26th week, and after your company start paying your illness or your sick pay, then you claim your income protection. Lump sum, on the other hand, is a serious illness, on the other hand, is a lump sum that pays on the specific illness. It's a once-off payment. It is for treatment and recovery, and common serious illness claims are cancers, heart attacks and strokes. Nevertheless, there are various companies and they do cover a wide range of serious illnesses, and including I had a client who was particularly asking about the breast cancer, and yes, it does cover breast cancer. So for female, it's a quite important definition, and myself being in my 40s and the group of friends we have, the cancer comes up and the conversations more and more frequently. Now, the older you get, the more expensive it is. The next and the most important protection is the life protection, okay? So we would have the personal needs that would, life assurance would protect the family, your mortgage protection, and your children's security. Now, how important, what's the amount you should get as an individual? It depends on your circumstances. If you have a small kid, obviously you want your kids to be grown until they are grown, so you have enough funds, or there is a big payment when you pass away, so the kids can go to college, your spouse can still educate them, their lifestyles remain the same, and there's no disturbance to their livelihood. Now, the business needs is you should be protecting your partner, you should be protecting your shareholder or the key person. Most businesses insure their premises, their vehicles, but they do not, most of them fail to insure the individual who actually generates that income and that business. So looking after your business is really important. If you're looking at the partnerships, or if you're looking at the limited company where you have 2 directors, if one of them passes away and you do not have a legal structure behind that, then you end up potentially working with his wife as another partner, as a business, half business owner. And you might not necessarily want to do that, or with somebody's child, to work with somebody's son who's being 50% shareholder in your company. So this is the protection in case something happens to your partner, to your shareholder, to your key employee. When that unfortunate event happens, it pays a lump sum, so you can escape from that kind of split control with somebody you don't really know necessarily. Now, the business, so it comes back to a kind of business protection again. So key business risks would be when the key employee dies, founder dies, or shareholder dies, or a founder simply cannot work. So the solutions are the key person cover, partnership assurance, shareholder protection, or executive income protections. Those are the tools to protect the income and the company and make sure that the company can continue being a prospectus and continuously grow. The retirement planning is the challenge is that we seems to live longer, or there is a longer life expectancy. There is definitely less and less state support, if any, for self-employed people, and greater personal responsibility, especially on building a financial future. So this will bring a little bit introduction to a pension, okay? And here we can see the power of tax relief and so there are two scenarios of option A, option B. In option A, we do a personal investment. So we do earn €100. We pay tax on it, so approximately €60 is invested. Now, any growth on that €60 is taxed with capital gain tax or dividend interest retention tax or exit tax through some life assurance policies. All of them are starting from 33 up to 38 or even 41%. Now, option B, if you would go with option B, who has enhanced tax relief and put this money through your pension, so you do earn €100. You receive on the full €100, you receive your tax relief, and the full €100 is being invested. Now, once this is invested, it grows tax-free, absolutely tax-free until you retire. So there's no exit tax, there's no capital gain tax, there's no dirt tax. All the earnings can compound. Okay, so that's the kind of something that you should consider when investing. If you invest and plan for the future long term, this is the tool, the most tax efficient tool, and Ian emphasized on that fact multiple times. If you would like tax efficiency, pension is the channel to do so. And why pensions are so powerful? A quick 3 examples. So this is just illustration, simple calculations. Somebody earns €80,000 per annum and he's age 35, so has 35 years to the retirement. Now he invests that money, he takes out €10,000 per annum and invest that money into medium growth of 4.5% investment with the current tax rules. So if somebody takes out just €10,000 after paying their income tax and puts it under the pillow or in the sock or wherever you put it to keep the cash, that will generate after 30 years, it's a simple calculation, 10,000 per year, it's 300,000. It doesn't grow anywhere, and we do not even take into consideration inflation, okay, and the increasing cost of living. And then the second option would be somebody a little bit smarter says, hey, I'm going to take out that money, but I'm going to make it work for me. So I'm going to put it through investment. Now, taking assumption that he still also takes out €10,000 after paying his taxes and puts it in the investment that grows 4.5% per annum, he is able, after 30 years, to generate approximately €506,000 in the investment. Now, if the same individual puts that €10,000 after tax, would be approximately 16,000 before taxation, and that would grow through his pension after taking all the tax-free lump sum, paying his tax on the next couple of quid. He would then the remaining just simply takes as a taxable sum. That's not the most efficient way to treat your retirement, but let's assume, just for illustration, that would generate 648,000 after all taxes. Now we can see the difference between just holding cash under the pillow, somebody who invests this, and somebody who puts it through pension fund, and how efficient is the pension fund in that illustration. And how does this pension outperforms? The tax relief on the contribution, tax-free growth, tax efficiency on the retirement options, and potential employer contributions, compound interest growth over decades. So earlier this year, on the 1st of January, there was a government introduced auto-enrollment, and loads of clients ask about that, and why do I pay so little? Why is it better than, or is it good to stay on the auto-enrollment? Now, auto-enrollment is a great starting point, okay? Employer contributes, you contribute, and also government tops it up with I think €1 out of every €3, so 25%. So eventually the tax efficiency on the contributions is 25%. Now, why does government give you that €1? It's a simple fact. They didn't structure properly, or maybe they didn't have enough time. I think 8 years was not enough, because I remember them talking about that back in 2018. Now they give that money back because all your contributions are already net of your income. So you pay your income tax, and then you do contribution to my fund. On the contrary of PRSA or any other pension scheme, where the tax relief is applied at source. So basically, before you do get paid the net salary into your bank account, the contribution is already gone before you pay your taxes, and it's very clearly visible on your payslip. Okay, so auto-enrollment is good. It's automatic. You don't need to do much. It's pretty much the one thing is for sure: the government will not take care of your pension fund for you in the future. Okay, you don't have any control over your contributions. You do not have any control over your investments. You are in default strategy, probably depending on your age. So most people would be in either medium, or maybe if you're young, in the high risk. But I understand that most of people are in the medium risk, and the closer you get to the retirement age, it would be back default to a low strategy risk. Now, PRSA, on the contrary, gives you that control, greater contribution flexibility, wider investment choice, tax relief, retirement flexibility, and engaged financial advice. I think I'm doing it wrong way. Now, the snowball effect, the magic of compound interest. So this is a simple example of €10,000 invested, and just let it sit. So if the growth is approximately, let's look at the example of generous growth of 8% per annum, over 40 years, that 10,000 will grow to over €102,000. Now, the obvious conclusion, and one of the famous saying, is time in the market rather than trying time the market. Okay, so simple words: leave it longer, greater benefits. Now, building the future for the next generation, that's where you, going back to our pyramid, that's where you look after your family and your children. Okay. Now, planning for children, most people plan for their future education, to save money to give to their children for deposit on the house, business startup, or just simply financial independence. Now, the solution and the best tax efficient, not as tax efficient as the pension fund, but one of the best tax efficient ways to gift your child any amount of money is birth trust planning. So there are at the moment two or three companies. I definitely am aware of two. I think there is a new one coming into the market, but that's not important, who provide a child saving account under birth trust. Now, this child saving account is like an investment account. You can pick your investment, you can pick the risk. It's you who are the trustees, who is the owner and who has the control of the account. You can contribute up to €3,000 per child, per annum, per parent. So effectively, if there are two parents in the family, they can gift to their kids to their child 6,000 euro a year. Now, how is it work and why is it efficient? Those policies are set up under Bare Trust, hence they are small gift tax exempt. What it means that if you do accumulate just on the individual side who doesn't use Bare Trust, if you do save money for your children's future, and let's say you save 100,000, and then you gift it to your child to do something with it, somebody eventually will ask, what's the source of your funds? Where did you get that money? And that's where the child will need to pay either the capital acquisition tax, or that amount will be deducted from their lifetime inheritance tax relief allowance, which is at the moment stands at 400. And I especially bring it up with parents of a single child. So assume you have only one child and you say, well, when I die, my child gonna get that house. Now, hang on there for a second and think about it. That the inheritance tax relief at the moment is 400,000 per child, okay? So let's say unfortunate event happens in 20 years and both of you die, and currently your house is worth that 400,000, just that limit. With the current property market and their growth, that house most likely in 25 years will be worth around 2 million. Now that gives the child, if you want them to keep their house and live in that house, they will have to pay 33% on 1.6 million. And you got it right, yeah. And that's approximately, almost 597,000 or something like that, around 600,000. So 600,000 needs to go to the revenue in taxation, and that's where the importance of Bare Trust comes into play, to lower that exposure. Do not eliminate that inheritance tax exemption, and just simply even 150 euro per month. Put away for 18 years, and if you would invest in a very high risk index fund, there is an index fund that generated over the last 5 years consistently over 15% income. That would be, the numbers are like over 180,000, but just in a kind of perspective of a kind of investment. This is investment. There are risks associated with that, and choice of investment. It's the time in the market, not timing the market. So putting away 150 euro a month can generate significant amount of money for your child's future. Okay, I think I stated too long a little bit on that, but overall, going back to financial planning. So financial planning, it's not really about the products, okay? It's about protecting what's important. And importance is, as the 3 pillars of the pyramid, is your income, is your family, and is your business continuity. And having all those 3 looked after, what you do then, you focus, your focus go on to building long-term wealth through retirement and investments. And Sena Brokers can help you to use those tools efficiently. Here on the screen you can see the QR code. You can book free consultation, and thank you very much. I'm open to questions. Thanks, Marcus.
That's a great thing they're open to questions, because there are a lot here in our chat, Michael.
Okay.
Amazing.
The easy ones.
Thank you very much for the presentation. That was really helpful. I'm sure there is so many people there in the chat that could benefit from it, because yes, pension is a topic that like loads of people talk, but at the same time it's a topic that like no one really talks about at the same time. So it's great to have someone like you giving a bit more advice and bringing light to the topic. So thank you very much. Really appreciate that. So let's go to the questions. So first question here that we have is from Ricardo. He said, I'm 35 years old, married with 2 children and a mortgage. What's the first financial protection policy I should prioritize if I can afford one?
Okay, so prioritizing and financial planning is all about your personal circumstances. Okay, just like Ian said in his presentation about the company, it depends from business to business, and here is pretty much similar. For individual, you should look what's your situation and what would you prioritize. And if you can afford, I would always protect the income first. You have a mortgage. Mortgage protection is already probably in place because requirements of the bank. And then family protection. Family protection, you can get additional level term assurance for yourself and start from there. Once you secure all that, those financial products or tools that helps you to protect your family, then we can talk about, you know, how to build your wealth. You know, different circumstances, different kind of priorities. Overall picture is the same. The pyramid stays the same. It's just when do you get what and how.
Amazing.
This helps.
Yeah, amazing. Thank you very much. Now I have two questions here that are kind of similar, so I'm just gonna ask you once.
Okay.
Can you help with mortgage applications? Do you deal with mortgages in any sort of sense?
My company, we do mortgages. We do full spectrum of financial services. So we do arrange mortgages, we do arrange life cover, we do arrange investments, we do financial planning, and we do arrange pensions. So yes, if anybody needs mortgage advice, pension advice, life assurance, or simply doesn't know where to start, I'm here to help. And just like with the first questions, you're not sure which product or where to start, which tool you should use to prioritize your financial goals, well, talk to us.
Amazing, amazing. See, so guys, if you're looking for mortgage applications, so any kind of support on this, you know where to find the man to help you now. Now, next question, Michael. How much income protection can somebody typically insure in Ireland, and how much would average income protection cost per month?
Okay, so everything with protection is associated with the risk. Everything in financial services is associated with the risk. So income protection. So basic rules, as I mentioned in one of the slides on income protection, would be that you are able to, most of the insurance company will pay up to 75% of your annual salary, proven annual salary. So if you're self-employed and you're getting income protection, it has to be the income that you generated through a trade. For limited company is a pretty much more straightforward. There is a salary that somebody is receiving. So if you are a business owner, you are also your own employee in such a sentence. The only differences between self-employed and individuals and the limited company is that who owns the policy. Okay, so for individuals and self-employed as sole traders, it will be you who own the policy. Hence, you can claim the tax relief of 20 or 40% at your marginal rate. On the contrary, on the other flip coin, there is a limited company and they are the policy owners. They do pay premiums, which is also deductible through in the corporation tax through taxation, and hence the whole payment will come to the company and they will distribute it to you through salary. So the income from the company is also from the income protection payments are just simply your income. So they tax deductible as a salary. And how much does it cost? I mentioned one of the slides, so it all depends on the deferred period. Obviously, the shorter you need to wait, the more expensive premium gets. So you can start with 4 weeks, the lowest waiting period. Then you can move to 8, 12, 26 weeks period, 13. That depends on the kind of setup. but mostly it's between 4 and 26 waiting kind of weeks, or deferred period it's called. And then you have the aspect of occupational risk. So what do you do actually for a living that defines the level of the premium? So there are occupations that are high risks, there are occupations that are less risk. So for example, scaffolder, somebody who works on the heights, would be very high risk and most likely uninsurable under the income protection as an individual. Now, somebody who has an office job would be category 1, so the premium would be significantly cheaper. Now, please do not forget that no matter what is the quote, then you can apply your marginal tax relief. So let's say €200 premium will cost you only €120. Okay, so it depends on the occupation. You need to kind of run the quote, and I need to know your age and occupation, and a little bit more details like salary.
Amazing. Thank you very much, Michael. Next question that we have for you is, for families with young children, what financial priorities should be addressed first?
Okay, so depending what stage of the financial life you are on, but let's say if you have nothing, but you do have you have your wife and you have children, so it's always starting with your income. You're generating income, you're a business owner, protect that first. Okay, now that's not always that doesn't always go in the kind of hand, because the premiums might be too expensive, because you are a builder, there's a high risk of you getting injured, so the premiums might be unaffordable. Nevertheless, if you put the income aside and you cannot afford the premium, always protect your life, protect yourself, and the life assurance will not protect you, it will protect your close ones, and that's an important way to think. I do not get life assurance for myself. I do get it for my children, for my spouse, who will be left behind. And we want to make sure that that they can afford the house, they can afford, if you're renting, that's super huge important, because if your partner dies, you are not able to pay the rent yourself, especially with one child. So therefore, you don't want to be forced either out of this country or back to your mama's house, or even share a bedroom with somebody, God forbid. So life, serious illness, and your children's future is, so the main products around that are pretty much protect your salary if you can, and if you cannot, protect your life. And you don't need the mortgage to have a life assurance, okay? Mortgage is there and it will be always protected because bank need it. Think about your family and the importance of protecting them, and don't leave them behind.
I hope this helps. So
priority depends how you look and what you can afford, pretty much.
Amazing. Thank you very
But
much.
for a business owner, it's more efficient to afford.
Those, especially the income protection, it becomes more better option than for actual individual.
There we go. Thank you. Thank you very much, Michael. So jumping on to the next question, right?
Okay.
So how much should somebody contribute to a pension if they start at the age of 35?
Okay, so there are revenue rules around pensions and on your contribution limits, especially if you start yourself, let's say, and you set up PRSA today. So the net relevant earnings are capped at 115,000, and the percentage of it depends on your age. So up to age of 30, you can contribute maximum 15% of your salary. So if you earn, let's say, 100,000, you can contribute 15,000. From 30 to 39, you can contribute a little bit more. It's 20% from age 40 to 49, 25, and so on, up to age over 60 when you can contribute over 40% of your salary. And now, it doesn't mean that you cannot contribute more. Yes, you can. But this is the amount that revenue allows for tax relief, which means that full €100 gets invested, not 60 euro instead. So how much can you contribute? It depends on your salary. So somebody who's 35 and earns 100,000 can contribute 20% of their salary as an ABC, as additional voluntary contribution, or as an employee. Because employee contributions are your contributions, your personal contributions, and AVCs are just the top up. So those boats are on the limit. Now, on the contrary, employer can contribute much, much more, and those limits do not apply. So if you are self-employed, and especially for business owners with limited companies, so you have your income, you pay yourself 100,000, you are 35 years old, you can contribute 35 years old, yes, am I right? So you can contribute 20%. 20% of 100,000 is 20,000 euro as a personal, as an employee or AVC or joint together, and that's what you get tax relief. Now, as a business owner, as a limited company director, you have a control of how much money actually goes into it. So employer contributions for PRSA specifically can be 100% of your salary. So if company has a leftover income of 100,000 in that example, and to pay corporation tax on that, if it's being left over through the financial year, to the next financial year, you actually contribute the full amount into your PRSA, 100% of your salary that you pay yourself. And that's how you extract money without paying tax and convert it into your personal wealth.
That's amazing and very helpful. Now, that was really good answer, a really good answer, but I just want to touch on that again because I feel like you answered how much you can, but the question is how much you should invest at the age of 35.
So how much you
can? Yes, so I said the limits, and I said how much company as a business owner can contribute, how they can extract the wealth from the company to your personal wealth. Yes, but how much you should? There's no right answer. It's like, what can you afford? What doesn't change your lifestyle? So if you have let's say spare income of €1,000 a month, and you don't have a specific goal, invest 500, invest €1,000 a month. The quicker you start, the better chances, and I will recall, if you do recall, the magic of compound interest, the time in the market, and that's when it plays. If you can, put anything. Yesterday I started, today I finished just before I left, I started a PRSA for a gentleman who's already 61. Now he can contribute 40% of his salary, but his salary is low, he's already contributing, and his affordability is he can only afford, he told me, €120 per month. And that's what he will put away. For the next 10 years, he's gonna put away €120 a month. And that overall fund we picked in his at his stage of life, and the short kind of period, he cannot lose much of that money. And we just set it up for €120 a month on the default strategy, which is kind of medium risk for that particular fund. And he's happy, and it will potentially generate him, around, the projections are around 18,000 at the end. And then he can take his tax-free lump sum, the rest as a taxable income, or he can buy annuity or so on.
Amazing. That was
The real answer is, there's no really right answer. It's like, what can you really afford? I have clients who can contribute €1,000 a month. I have clients who can contribute, as just by this example, 120. Now, can you contribute 500? I will. You know, if I can, I can. So I will.
Okay, amazing. Thank you very much, Michael. Now, next question we have for you, right? I recently started a business. What should I focus on first? Pensions, investments, or protection?
Okay. So you started a business. So let's say it's working well. Okay, we're not talking about you started it yesterday. So fresh business would be, let's say, 2 years old. You're already generating income. Okay, so you should start with what you already built. Okay, protect the business income, and the business is yourself. Okay, so income protection, executive income protection for business owners. Okay, if you in partnership, okay, you can get life assurance for the members. Okay, so protection is a kind of basic, because if you do not protect the income, there won't be any business in the future. Okay, so protecting the business and income protection, permanent health insurance plays significant role here, because if you do, just like a friend of mine, he's actually employee, but if you could imagine that you are healthy, you look after your health, and you play football or you play rugby, and your disc slips and you're out of work for 2 years, and your business is, let's say, cutting hedges or gardening, that's it. There's no business anymore. So income is the base for everything that evolves around the financial path and financial goals. So we set the goals where we want to go, and we protect what we have, our family, our income, our business. There are tools, products around that to protect each and single one of them, and we build through the wealth with investments through the pension, and that's the way to go ahead.
Amazing, fantastic, thank you. Next question that we have for you. That's a very, very good one. If I already have life coverage through work, do I still need my own personal policy?
Yeah, that's a discussion I had with one of my clients, and the simple, how to make it simple, but usually the life cover through company is 3 to 4 or 5 times, maybe you're lucky if there's 4 or 5 times your annual salary. So if somebody who has 30,000 euros annual salary, his life is protected to an extent of 120,000 of a payout in case of death. Now, imagine that you have a family, but what's important is it's not even that. Will that be enough? The question is how long you're gonna stay with that employer. Okay, if you're young and you frequently change jobs, and I was in the situation myself that, you know, before age of 30, my average job was 18 months. So there is never pension fund build up. There was never a kind of life and protection in mind. But you know, if somebody who has a family, like, get a life protection addition, even somebody who I have clients who have mortgage protection on the mortgage they pay. Okay, so their life is protected. They have 4 times their salary, which is quite good, and then they still do understand the risks and when their child gonna grow, and how important it is that whoever is left behind is not necessarily become millionaires, but it's just their lifestyle doesn't change through that unfortunate event. So yeah, protect yourself. You know, there's never enough. There are limits of how much you can get life protection or income protection. But in this particular case, serious illness, sometimes you should sacrifice a little bit of the life protection onto getting a small lump sum if something happens. Especially cancer is a kind of very common illness these days, and younger and younger people do get cancers. So it's important for somebody to consider all that, to have it, to have it under your control, not control of your employer. You're not gonna stick with that job forever just because of the 4 times your salary life protection, right? So you need to ask yourself a question like that. What if I'm gonna be redundant tomorrow? And that's it, the life cover is gone. Now you're 48 or 49 with health problems. Obtaining your own life assurance might be questionable.
Okay, amazing. That was very insightful. Thank you. Next question that we have for you is, what documents are normally required to set up a PRSA in Ireland?
Okay, PRSA, it's very quick to set up. All you need is a photo ID, proof of address, proof of your PPS number, and and banking details. That's pretty much it. Obviously, we go through all the financial advice, and we do explain the risks and the retirement and how the fund works and what actually product does for you, and the risks you take associated with the investments that you pick, and we kind of work around the strategy. But setup itself, it's pretty much straightforward. It's worth to remember the engagement with financial advisor, okay? He will know your secrets, okay? I'm not talking about those secrets that you think of, but I do need to know all the details of your income, of your saving accounts. Can you afford that? I need to see that. And there's a document called Fact Find. So it's a principle and basis for all the financial advice. So I collect certain amount of data or details on you, your situation, your personal income and so on, and your assets. And based on that, we can identify, retirement. It is your next step. And, if you did come to me for PRSA advice, how quickly we can set it up? We can set it up today, pretty much, if you bring those 3-4 documents. If we're getting involved with your employer, it's also quick. It's just another document for your employer to sign, and we need their registration number or so.
It's pretty much straightforward.
Very quick.
Amazing. Thank you very much.
It's all about the decision making.
Do you want it? Do you need it? I want it. Let's do it.
Amazing. Thank you very much, Michael. Next and final question, right? So, next question that we have for you is, why is income protection particularly important for self-employed professionals and business owners?
Why income protection is important? Okay, so that goes back to the basis, and that one of the fundamental pillar of our pyramid of financial planning, and income is pretty much everything. That's where it all starts. If you do not protect your income as an individual, okay? As an individual, is not as harsh on you if you lose your job, okay, or you're not able to work. There will be, your company gonna pay your, let's say, sick leave. There will be eventually a state benefit, illness state benefit will be payable to you at the social welfare rate. So you are kind of protected as an employee. So for an individual who works as for somebody, it's not as much necessary. It's just your income gonna be significantly reduced, but there is still income. On the contrary, with self-employed people and how important income protection is for businesses, if we're talking about self-employed individual who, now self-employed I refer to as a sole trader, not a company. You are the business, as Ian mentioned before, and therefore it's just paramount. If you do use your phone and you insure your phone, if you do insure your car because it gets you from A to B and it's important for you to have a car for work, or shoes for running, you insure those elements. And income for a sole trader, you need to insure yourself from a potential job loss, because there's no support for yourself from pretty much government, just like for employee. And it goes the same for a business owners of a limited company and their kind of executive team or key employees. And the best thing is that, you know, both individual, self-employed, can still get the tax relief on the premium. So €200 premium will cost you only €120, because you do get it potentially if you pay 40% tax. And for on the corporate side, if you do own limited company and you do insure yourself from through permanent health insurance, now it has to be a qualifying product, and qualifying product approved by the revenue for tax relief is permanent health insurance and income protection. Now on the corporate side, is just as an expense. There's no tax relief on your personal, because you do not pay the premium. Sole trader pays the premium, individual pays the premium, but in the company setup, it's the company who, as a separate entity, pays the premium, hence they're getting not as much as tax relief on the premium, but they put it through their costs.
Amazing.
So it is.
Income protection is a kind of principle and the basis for everything we build around our income. And I mentioned the biggest risk is to lose the ability to work. And as we saw in the previous, individual 35 years old, 30 years to retirement with 60,000 per annum salary, potentially could earn 1.8 million in those 30 years. So this is how much your potentially could lose or kind of stop having. That's how much it's worth. Your ability to work is worth in that case.
I think that's this question is exhausting.
A very interesting and important presentation with clear and well explained information. Thank you very much. That's what Ricardo said on the comment section. So thank you very much, Michael, for this. That was absolutely brilliant. With that ends our questions for Michael, and that means that we are coming to an end. I know, don't be sad. I know that you love being here with us and learning so much important information, especially as business owners. But on that note, I would like to say that Business Clinics, the BICC Business Clinics, will be back on the 13th of August. And the topic is very important, especially if you own a business. People and operations management. So I'm sure you don't want to miss that. I would like to take this moment to say thank you very much, first of all, to our speakers, Ian McDonald from Core Accountants, and then also Michael Kashmir-Chek from Santa Brokers. Thank you very much to every single one of you that was at home watching, and especially to the ones that participated here with us, sent a few questions. We really hope that this session was insightful for you and that you can close your laptop or turn off your screen, having learned something new today. If you did, that's what matters for us. So, otherwise, as mentioned earlier, tonight's webinar has been recorded and will remain available here on the BICC channel on YouTube. So please feel free to revisit at any time that you would like to. If you found today's sessions valuable, please take a moment to give us a follow and subscribe to the channel. Sometimes I confuse the platforms, Your support helps us continue delivering free educational content to such a beautiful community that we've been creating. And I hope that you join us again on the 13th of August. And we have news. So, before we actually end up, I would like to share a quick preview of a new initiative that the Brazil-Ireland Chamber of Commerce will be launching soon. The BICC Community Talks will be a free program open to everyone, covering topics of broad interest and relevance to the Brazilian community here in Ireland. Our aim is to create a space where people can access practical information, expert insights, discussions on subjects that matter to our community. We'll be sharing more details in the coming weeks, so we encourage you to follow our channels and stay connected. You can find us on Instagram at Brazil Ireland Chamber. Make sure to follow us so you don't miss updates on this new initiative, and as well as our upcoming events and programs. We look forward to sharing more with you very soon on that. And we had so much amazing questions, we had so many important information shared with us here today that we went over our time, so that means that unfortunately our networking session on Google Meets will not be happening today. Although, again, we really appreciate everyone who took the time to be here with us and participated with us. And we will see you next time. Thank you very much, and we hope you enjoy your evening. Ciao!